we talked about various trading strategies and their differences. So I believe all these things, you don't have any question. Now, this is what is more important.
Excuse me, sir.
Yeah.
Sir, I had a question on high frequency trading firms. Should I ask it after the class? Like,
Better if, yeah,
okay.
you can ask, yeah.
So right now?
Yeah, go ahead.
Sir, I read about something like the 2010 flash crash,
Right.
and this
US flash
some
crash, right? Yeah.
blamed high frequency trading firms for that. Can you just shed some light on that?
Yes, actually, I also have one paper with other two co-authors on Indian flash crash. So you are talking, he is talking about, I believe, May 10 or May 6, I believe, 2010 in US there was a flash crash. So what is flash crash? By name itself, it's flash means there is a sudden drop in the market. Means there was a immediate decline in the market. And though there are various stabilizing mechanism, for example, we have trading halts, trading halts, and or we call it circuit breaker. So there are various names: circuit breakers, or also we have a stock specific price band. So basically you can think of this is some kind of a mechanism where based on certain index. So let's say if you are following NSE 500, so there will be, based on previous date, there will be a range of high and low. And then if price movement is below that, there will be a halt. Or if price movement is beyond that, so there will be halt. It means price will be allowed to move within this range. So we call it circuit breaker or trading halts. And also for various stock, there are this kind of band. We call it price band. If you go and search, you will find based on the stock specific, based on the value, there will be different type of price band. In US, what happened? There was a flash crash, and what was observed that in flash crash, because high frequency trader can trade quickly, because they have algorithm, they have various mechanism for quick order submission and execution. So they get advantage of speed, and they take front runner role in the market. And that's why in flash crash time, it was, even if you look at the paper by Maureen O'Hara and Easley, and paper by I think in Arvind Dar, he has also written paper on US flash crash. They have said that because high frequency trader, they want to take advantage of this kind of sudden panic or sudden uncertainties, and that's why they were blamed. Even when in our my paper with Stephen, we have also found in India we had flash crash on October 5, 2012. So we had a flash crash because of wrong order submission. There was a company we called AMK Global. So what has happened, because MK had facility to punch order quickly in the market, so they punched erroneous order, and because of that market got, we witnessed flash crash in India. And it happened because there was a mechanism by which large volume can be pushed in the market. And same reason was also there, more or less same reason, because when algorithmic trading and high frequency trading trader, they came to know in US that this kind of uncertainties are there, they start trading in that uncertain period. they start, because they had high frequency order submission facility, they misutilize it. And that's why whatever he has said, this is very valid, that many times we observe that high frequency traders are taking advantage of their speed. And that's why other traders who are, retail trader are not having facility, they pay, for high to, they pay to high frequency trader. So, or they make losses because of, advantage that high frequency traders get from their, trading desk. Yeah, so there are papers, and your point is very valid. Even if you look at short seller in US 2008, short selling was banned. So if you are interested, anyway, we'll be talking about short selling. It was banned in US in 2008, I believe in 7 also, around a global financial, when Lehman Brothers crisis happened. Because there was lots of uncertainty, and then short sellers were blamed. But when you look at the literature, short sellers are basically, a short seller or high frequency trader. When they trade, they allow information to flow quickly. Basically, they are medium for information transmission. So when we blame them, it means we are blaming to information flow, because when they trade in the market, by trading activity, they they provide information, useful information to other market participant. So I think, yeah, blaming them may not be appropriate, because at the large extent they are providing liquidity in the market. Of course, they use certain strategies, and because of that they were blamed. Yeah, and any other question? Your question is very correct, and they were blamed, and they were blamed because of they can go for certain strategies at micro level or very high frequency high frequency level. Yeah. And any other question related to this? Fine. So I believe we know what kind of trading is going on. It is better if you go and read certain article, then you will realize that how much potential is there in this domain, especially this high frequency trading, or when we talk about exchange or trading mechanism, we classify it into a different finance domain. We call this domain as market microstructure. Market microstructure. Microstructure means how trading or all these mechanisms are impacting the market. So this is new stream. So when you read, then you will realize that there are lots of things are going on in this domain. So now coming back to our discussion, buying on margin. Those who have traded or having any kind of trading account, they can really appreciate what is margin. So basically, margin means you are taking advantage of leverage, or you are taking advantage of debt financing from the broker. For example, here when we take definition of buying on margin, when purchasing securities, investors have easy access to source of debt financing. It means when you are buying, you take loan from your broker and you buy it. So whenever that kind of buying activity happens, we call it margin. And why this facility, generally you get from broker, because broker is a kind of, market maker, or he will charge for his or her service when they are offering to their client. And they will only get client when they can offer some kind of advantage. Because many times, especially when you want to trade intraday, and let's say you want to trade and you need, let's say 10 lakhs you have in your account, and you need to borrow some additional money from your broker so that you can execute your strategy on a given day. So broker, that time your margin trade, buying on margin facility will help you. So we will see how margin impacts whenever we talked about, trading activity, or when we talk about return for investor when purchase is happening in terms of margin. So here we will, so basically what is margin is whenever investor buy certain, security or asset on loan, and that loan he is getting from the broker with certain condition, and that condition we call it margin. Condition means whatever terms is there. It will come in next slide. So basically what is happening, purchasing stock on margin means investor is borrowing. So one activity which is happening is borrowing, and the margin is basically account is the portion of a purchase price contributed by the investor. So basically, if you purchase, you are purchasing, any stock of worth 10,000, and out of 10,000, your contribution is of rupee 4,000. So in this case, your margin would be 4,000 divided by 10,000. So basically 40% is your margin, and remaining amount is basically your borrowed amount.
So your screen is not visible. Can you please share it again?
You can't see my screen?
No, sir, I cannot. I don't
Okay.
know.
I don't know. I'll reshare. So can you see? Hello?
Yes, sir,
Oh,
I can see it.
Okay, fine. I guess there was. So here, in this case, what we are saying, let's say you are purchasing worth of 10,000, stock. Let's say 100 stock, number of stock 100, and you are buying each stock worth is 100. So basically, you are buying 10,000 worth of stock, and in this, your contribution or whatever money you have is only 4,000. So it means 4,000 divided by this 10,000 is the margin, and it means 6,000 you are getting from your broker. So this is how we calculate. And now we will take example as well. So whenever we talk about margin, so basically this is the ratio of net worth. When we say a ratio of net worth means basically equity value of whose basically equity value or contribution of investor. Because whenever we talk about equity value, we are referring to stockholder or investor, how much money he or she is using to buy a particular security. And for every inventory position, whenever you are buying or you are selling, a maintenance margin is set by the broker. Because it cannot be the case where you can go and take a loan or borrow money from your broker, because at the end broker is, let's say if broker is here, broker is connected with n number of different investors. And if all investors start taking loan from broker, probably, and without setting some kind of condition, broker wealth will come down in case all investors lose their money in their trading practice. So it means there should be some criteria to keep check on the margin account, or how much amount you are borrowing. So a maintenance margin account is set, and this is set based on the condition that broker puts. Why broker will put? Because broker knows that if for example in bank also, when we go and take loan, bank says, okay, you have collateral of let's say 1 crore, but I can only give you loan for let's say 70 lakhs. So same way, based on the worthiness, trade worthiness, and relationship with the client, broker sets. and there is minimum guideline. So below that your broker cannot set. So that guidelines is generally provided by SEBI. So it means whenever we talk about trading in the market, and or when you are having account with your brokerage firm, a maintenance margin account will definitely be there. And whenever your margin, when the percentage, we will take also example, when if the percentage margin falls below the maintenance margin, it means, let's say earlier we said 40% was your what you call contribution out of 10,000 worth of purchase. So this was your value of security, and 4,000 was your contribution. So whenever let's say if your broker said that certain margin, so whenever your contribution comes down, then you will get a margin call. Margin call means a kind of communication from your brokerage firm to fill that gap. So you will have to maintain your margin account. So we will take, let's say we will take this example, and then we will be able to relate these two concepts. So suppose an investor initially pays 6,000 towards the purchase of 10,000 of worth of stock, and he is borrowing 4,000 from the broker. It means 6,000 he is contributing from own pocket, and 4,000 he is contributing, he is taking loan from the brokerage firm. So here, if you want to calculate the margin, so in this case, value of stock, if you see, it's 10,000, 100 stock, each stock value is $100. So 10,000 is the value of stock, and investor having $6,000. It means 4,000 he will have to borrow from the brokerage firm. So if we want to calculate margin, margin would be how much money investor is putting, or we can call equity amount of investor. So 6,000 divided by worth of this. So basically 60% is the margin. Now, because once you purchase this 10,000, there could be various scenario. Price may go up, price may go down, or it may remain same. So let's say if price of your holding or price of your stock comes down from $100 per share, it comes down to your 70. So what will happen? You see, we are going to compare basically this scenario. Sorry. We are going to compare, initial scenario when you purchase, when price was $100, with scenario here. Now, what is happening when value came down to 70? So your total holding will be $70 into 100. Sorry, 100. So 7,000 will be your holding portfolio value. So in this, what has happened basically? Your whatever you put, that amount is as it is, but there is a decline. 4,000 was your initial amount, but your 4,000 you have taken loan from the broker, and your equity amount earlier that you paid, because why broker will bear this kind of loss? Because you have taken loan. So as an investor or as a client of your broker, you are going to bear a risk of decline in the value of asset. So 3,000 is going to, so by 3,000 your equity amount is going to reduce. So now if we calculate here in this scenario margin, so margin will be 43%. 3,000 divided by your value of asset. So here what we are basically calculating, we are trying to see the margin, how much margin you have, or how much margin you have in this particular security. So basically margin is nothing, how much you are putting, or what is the contribution of shareholder or investor divided by value of investment or value of portfolio. And same way here, if you see, once you prepare this based on the change scenario, price came down from $100 to 70, we can easily calculate. Now question comes, when you are expecting to receive a margin call, because price may keep on going down, there should be a threshold where whenever that threshold is triggered, or whenever price of your portfolio comes down to that level, you should get a call or you should get a communication from your broker. So now we will see how maintenance margin works. So suppose with same problem that 6,000 as an investor you are contributing $6,000, and total your holding value is, let's say, 10,000. So in 10,000 you are buying 100 shares of $100 each. So same example we will continue. So suppose that maintenance margin is 30%, and this is set by your broker. Remember, broker, if you are having account with ICICI security or SDFC security, so that your brokerage firm will decide your maintenance margin. So let's say if maintenance margin is set 30%, so how far could your stock price fall below the investor would get a margin call? Assuming that, so what we want to know, up to what price, you won't get your call from your brokerage firm, because you need a trigger point. So what price is going to be trigger point when you expect to receive a call or a kind of communication from your brokerage firm to maintain your minimum maintenance margin? So let's say here, if up to, so this is, if you remember, 6,000. So your initial, your contribution earlier was 6,000. How 6,000? Because you're holding 10,000 minus 4,000. So in this way, same way we are assuming that your margin would be your contribution. Your contribution will depend upon number of share into price of share minus how much you have borrowed divided by number of share into price. So this is the same formula. Here what we are changing, here we are trying to see up to what price level your value of asset can be allowed to come down before getting a call from your brokerage firm. So this is very simple case. So now with this, and as you know that margin is 30%, means 0.3 from your, it is set by your broker. So it means you can expect to get a margin call or a communication from your brokerage firm at whenever your price reaches to $57.14. So you purchase at 100, but if value of your stock comes down by this, you can expect a margin call. Why? Because broker has set this value. So now if you are holding demat account, or anytime if you have traded and you witness this kind of margin call communication from your broker, you should be able to relate it. Why you are getting this? Or when you open your account with brokerage firm, what kind of maintenance margin was set by your specific brokerage firm? And that's why this definition of margin and how it works should be clear, especially whenever we talk about trading, or whenever we talk about creating portfolio. Can we move ahead? This is very simple concept, but many times we get confused. What is margin? What is maintenance margin? And when we are going to get a margin call?
Sir,
Yeah.
there was small doubt, sir.
Yeah,
I
yeah.
had a question. Why would the broker would give a loan to the person? Like, what is the benefit the broker is getting in that?
Yes, because broker is getting business. Whenever you buy and sell, broker get the business for your buying and selling. And unless you remember, now you have n number of brokerage firm, SBI, every bank will have one brokerage firm. So you see there is a competition, and unless they provide this kind of additional benefit to their client, why client will trade? For example, if you see when we talk about intraday trade means at 9:15 market is opening and market is closing by 3:30. So let's say if intraday, let's say there could be a scenario where you know that particular stock price will go down in second part of the day. And here, so what you have done, you have basically sorry. So what you have done, so unless you have this flexibility, you may have less amount. So what you can do, you can short stock here. You can do go for short selling here, and then in evening you buy at lower price and then settle with your brokerage firm. Same way, unless you get this kind of flexibility, you won't find any advantage in trading activity. And that's why to attract more client, these kind of incentives were created by different brokerage firms.
Okay, sir, got it.
Yeah. Hello. Any
Yes, sir.
other?
Yes.
Yeah, others. Can we move forward?
Yes, sir.
Okay. Now we have understood what is margin, when we expect to get a margin call. Now we will take one example and try to see how margin is going to impact your return. So here we'll take one example. Assume that you have purchased a share at $50 and a $5 increase in price happened over 6 months. So right now you can assume that $60 is the price of your stock. So in this case, so if you want to, we can want to calculate what is the return considering the margin, and we are assuming that interest rate on borrowing. So when if you go and borrow, your borrowing interest rate is 6% annual or 3% semi-annual. So this is additional information we are assuming. So let's first we talk about how much return you get if price of your stock goes up by $5 in 6 months. So in this case, your return would be simple to calculate. Amount of appreciation divided by your initial P0, initial purchase price. And if margin is 50%. Remember what is margin? Margin is basically a kind of borrowing activity. Remember, in earlier case, we have seen margin was we calculated 10,000 minus 4,000 by 6, and here basically what is happening, there is a kind of borrowing. Your broker is allowing you to borrow. So if margin is of 50%, it means if you have purchased, let's say 100 stock initially and price of each stock was $50, so total amount you invested 50,000, and because margin is 50%, it means you pay 2,500 and remaining 2,500 you have borrowed from your, this is your borrowed amount from your brokerage firm. So here we are assuming that we are saying that margin is 50%. So and because this is a kind of borrowing activity, and we can relate this borrowing activity with certain cost. We assume that there is a cost of 6% annually or 3% semi-annual on this. So here It means out of 50 rupee, 25 rupee cash was, contributed by the investor, and remaining 25 dollar was, contributed by the broker, and broker has contributed because, there is a, a condition that for every 6 months you will have to pay, or investor will have to pay 3% of interest on borrowed amount. It means out of, if one stock you have purchased and you paid $50, and out of $50 you paid from your pocket $25, and remaining $25 you have borrowed from your brokerage firm. So it means on $25 you are going to make payment of 3%. So basically 75 cent is your interest charge, or interest you will be paying for 6 months. And now if you want to calculate your investment, because basically how much you have invested only 25 rupee. So in that case, your investment comes around 17%. Of course, when we look at this aggregate level, it seems you made 10%. But when you adjust for your margin or advantage that you got from your brokerage firm, you can see, you have realized more than what we are seeing here at aggregate level. Right. So this is the basically impact of margin, or impact of, margin advantage that investor get when brokerage firm allow this kind of borrowing. And it is allowed. You go, and if anyone has traded, I think definitely you will come across. Of course, interest rate will vary based on market condition, because in India we have, around 5 to 6% interest rate on deposit, whereas in US it is around 1.5%. So it means you will have to consider country specific interest rate. So otherwise you will find this kind of provisions are already there. So those who are trading on margin, or they are utilizing this kind of facility, understanding of this concept will be very much helpful. Now we can generalize this. So here we have seen a case of this, and there could be a scenario when a price may go down. So if price is going down, there will be asymmetry. Earlier price, when you purchased, price was $50. Now it came down to 45. Still, you are contributing how much? 25%. So when we calculate how much return or gain or loss you have made on this, because considering your margin account or margin trading, it comes to minus 23% of decline. Right, because we are using non-symmetrical calculation, and that's why this kind of variation we are observing. Now we can generalize this. Whatever we observe here, we can basically generalize this. So return on your investment considering your margin account. So basically this formula we can use to define it. So this is what we have seen earlier. So this is your, RS is your 10% return. Remember, if we go back, so RS is your initial return, and your, price, interest rate. So when you calculate, basically from here we are getting this expression. So we can represent, your, return, or your return on your, contributed cash in terms of your margin. So this formula will help you to understand well. Otherwise, you can also go in this way. First step you calculate aggregate, then you adjust margin and calculate. So this part is clear. Margin part.
Excuse me, sir.
Yeah.
So isn't this ratio RC a bit misleading in the sense that it doesn't factor into account the liability that we owe to the broker? like we borrowed $25 from the broker as well. So here the return that it's showing us is just that the
yeah, it is showing basically what it is showing. It is showing that broker is never like, ideally you think when you are trading, broker is playing a zero sum game. When you gain, he will make money. When you are losing, you are going to lose. And in denominator, this is basically, your contribution, how much dollar value you have contributed. So your point is very valid that, yeah, it is not, symmetric. That's why I said it is not symmetric, but it follows, theory, whatever behavioral theory we have, like behavioral theory suggests that when we incur loss, we take it, more seriously. And when we make, gain, or when we make profit, we say that, okay, our profit is not very serious. So we are having different kind of attitude towards loss and your gain. So this is, similar kind of interpretation, we can give.
And so is there any condition like this that suppose if I am gonna sell that particular stock which I had bought using that margin value, so if I'm gonna sell that, then I will have to give back the money that I have taken from the broker?
Yeah, so that yeah, you will have to give back. Yeah, that's why I said when I'm going to talk about short sale, you will understand. So see, broker will definitely, broker is only giving you facility. For example, when we take loan from the bank, of course, whether you are able to pay EMI on time or not, but you will have to, at the end, you will have to pay. Bank is not going to bear any risk unless government comes and gives bailout to bank or some kind of, additional package. Right, so all the loss you will have, or investor will have to bear loss. The only advantage investor is getting through brokerage firm is margin, because brokerage firm is allowing to borrow and trade on margin. And but for that margin, of course, you will have to bear some kind of cost, like 3% in this example. For annual, we assume that 6% is charged, so effectively 3% is interest you will have to pay to your brokerage firm on amount that you have taken as a loan. And of course, you will have to return entire amount. There is no doubt. But here what we are saying, you are maintaining your account. You are not closing your account with your brokerage firm. Once you think about closing your account with your brokerage firm, then you will have to go for net settlement. Right. So yeah, so right now we are assuming that you are maintaining, this is a running account and you are maintaining it. So in case of margin and this kind of movement in your specific share, how your return can be calculated. So this is what we should infer from our discussion.
Okay.
Yeah. So now this is very interesting. Even in if you want to go for intraday, this is especially in US, short selling is extremely used. And there are various type of short selling, so we won't go into various because that is based on condition put by the respective exchange. Exchange means in India we have a regulatory body, SEBI, in US we call it Security Exchange Commission, SEC. So in short selling, what is happening? Let's say at t is equal to 0. Let's say you get information that price of particular stock AB will go down in evening, right? And you having your holding in this stock is 0. So your holding in AB we are assuming at 0. It means you are not having this stock at all. So what you can do? So if short selling is allowed and your brokerage firm like ICICI Direct or other this kind of brokerage firm, they allow you for short selling. given that it is allowed by your respective regulatory body. So what you can do, let's say you get information that this stock price will go down in the evening. So in the morning, what you can do, you can borrow, let's say 100 share of this, you are borrowing from your brokerage firm. So your broker is giving you this for single day, because we are assuming that you are going to take your position, you are going to cover your position in a single day. So what will happen, because this facility is allowed for you, so you have taken this 100 share here, you have taken this as a loan. Loan means you have borrowed this share. So what you are going to do, you are going to sell here, you are selling AB here. So what is happening here, basically you are shorting it. Why shorting we are calling? Because you are selling, and you are selling without having ownership of this stock. So what you have done, you have borrowed because your broker said I have a number of clients and they already have good stock. So if you wish, I can give you 100 share of AB company. So what you have done, you have borrowed it based on certain terms. It could be he can charge you, let's say 50 paise per stock as additional cost because you are borrowing it. So I'm assuming that is zero. A broker has given you free of cost with the condition that at the evening time before closing of exchange on a particular day, you are going to return back 100 stocks. So let's say, so what you are going, let's say here you had that information that price will go down by evening. So you have sold it, and you have sold, let's say at $100, 100 stock, $100. So basically you got 10,000 rupee, $10,000. And in the evening, if price of this AB stock, let's say came down to $80. So what you have done, you have purchased, you have buy $80 into 100 stocks. So basically you paid $8,000 to buy this. And then when you purchase these stock, 100 stocks, you have returned back to your brokerage firm. So in this case, if you see your difference, so you sold at this and purchased at this. So 10,000 minus 8,000, this was your entire, squaring your position, and 2,000 you made profit. And let's say here you also paid some amount to your brokerage firm for providing this service. You will have a net profit. But this facility you are getting because your brokerage firm is giving you option to borrow and go and short this excess, these shares. But at the end, you are covering your short position and returning back all these stocks to your brokerage firm. So this kind of activity, we call it short sale. And in my initial discussion today, as I said that in around 2007-8, there were various blames on short seller in US. Even a paper by Chinmay, one of my friend, if you look at paper by Chinmay Jain, he has written paper on short selling. So you will find very interesting case where short sellers are making profit. Of course, if you look at this entire exercise here, what the outcome, final outcome is information flow. And information is coming into the market through short seller. So in ideal scenario, one way we appreciate that, if you want efficient market, everyone should be allowed to trade. Because unless we trade, our trading strategy won't, our information won't come into the market. And if information itself is not coming, your price of asset will never show the fair value or true value, because unless information comes and it is adjusted in the stock price through trade, we cannot say market is efficient. So that's why even if you look at the literature, you will find two type of argument. One argument, people have blamed the short seller, and there are various people who supported them. Why supported them? Because they are saying short seller do not create any pressure in the market, but they are a key trader or key market participant who brings new information on the table or in the exchange. So if they are bringing and we are penalizing those type of trader, that is a wrong practice. So you will find both side of argument, but we don't know. You may find supporting when you do some kind of analysis. You may find some kind of supporting argument, or you may want to blame them. And if you want to go for trial data, so there is a NASDAQ provides you data on short sell, so you can go for look at test sample or test data, or there is a dedicated website. We call it shortsqueeze.com. So shortsqueeze.com, because I have used US data, so shortsqueeze.com provides you short selling data. So you can see open interest. Open interest means how much people have shorted but not covered. So those are basically some kind of sentiment indicator as well. So you can look if you want to do some kind of a project, you can get sample data and analyze short selling. What kind of short selling is happening in US. So this is very interesting dimension, especially from portfolio point of view. When you are going to help your client and you are allowed to participate in market like US and Australia, you will find very interesting. You can explore. In India, we have certain restriction. Intraday, I believe short selling is still not allowed. So especially in equity. So you can think about these, but these concepts are well known, well established in portfolio theory. So already we have seen what could be the net impact. This is one empirical example. So like in shorts, in normal buy, what happens? We purchase the stock, then we enjoy. If stock is giving dividend, we get enjoy dividend and we sell it. So your profit from normal trading in price plus dividend is how much you get minus initial price you paid to buy this share. Whereas in short selling of a stock, you are borrowing, then you are, if payment is some kind of assuming that long period short selling is allowed. So in that case, your initial price minus in price minus dividend. So this is how your profit for short selling will be calculated. So here we have assumed that not only intraday, you can intraday trading is allowed, and where some kind of dividend payment was there. So this is how we can classify and distinguish normal buying and selling versus short selling. Now we will look at this is consumption theory. Whenever we talk about portfolio, we are always worried about investors perception, investor consumption, because consumption and investment both are very much related concepts. Even unless we understand relationship between these two, we cannot think of a portfolio or any kind of investment in the market. Because if you are getting X amount, and unless you save, you cannot invest. So this is this kind of scenario. So we will take that scenario and try to see how consumption can lead to certain kind of opportunity set or certain kind of portfolio set that can be considered by the investor who are there. So we will take this example so that easily we'll be able to understand. Consider an investor who is receiving income of $10,000 in each of 2 years, and assume that only investment is available is the saving account, and that gives you 5% per year interest. If you deposit, only one option is available, you can deposit it, and if you deposit 5% interest you will get. At the same time, it is also allowed that you can borrow at 5% rate, because we are putting some kind of restriction that only one investment option is available and you can borrow and enjoy yield or return at the same rate. So now question comes, how much investor should save and how much he should consume? Because by looking at this, this is 2-period model. So by looking at this, we don't know what ideally should do, because it seems either you lend it or you deposit in the bank, your return is basically 5%. But to understand properly this particular case, we need to look at what possible scenario exists for the investor. Right? So we will take what kind of options are available for the investor. So basically we can split our analysis into 2 parts. First, we look at the options that are available, and then we see which one investor is going to select. Because when we say which one where investors preference or investors indifference curve comes into the picture. So first question, we will try to address this. What are the options? If options are there, what kind of profit or gain investor will have, and then we'll see what is the best optimum investment policy for the investor. So this is what a case we have, and we will try to understand it. So now we are going to look at the option. Option number 1, you are getting 10,000 first year and 10,000 second year. You consume it, you will have fun. So in that case, so if you look at B case, so here you have period 2 and here you have period 1. So what is happening if you enjoy 10,000 that you get in first year and 10,000 you get here? So you will have this kind of curve or this kind of consumption pattern. Now we are going to look at second case. In second case, what you can do, you save all the income of first period and consume everything in second period, right? So what we are saying, so if we put timeline, this is 2 time period. So whatever you have here, you have 10,000 and here you have 10,000. So what we are saying that you would save all the income of first year and consume second year. So this you are going to consume it all, and this you are going to save. If you are saving for how many years? You are saving for 1 year. This amount, and you are saving at 5%. It means your value of your this will be 10,000 that you consume, and then you also get 10,500 that you deposit for a year. So basically this point you will be. So here remember you are consuming this, and then and then you are depositing another one. So this is your opportunity set or another point we get. Sorry. Now third case. What third case? Because here we think of depositing money. There could be scenario where you can borrow. So what you can do, another possibility is you consume everything now and don't worry about tomorrow. It means this money you consume here itself. Right? Means whatever you are going to get, you borrow it. You take it, you pay 5% interest, and you enjoy here itself at this first stage itself. If that is the case, it means if I want to know the value of 10,000, which you get in here at this point of time, it means I need to calculate the present value. So basically, this will be the present value of 10,000 if you borrow it for a year at 5% interest. So in this case, 10,000 plus present value of 10,000, which is $9,524, your total amount that you can consume or you can enjoy is 19,524. So basically, this is the third case. So what we have here, if you see, from here to here, from point A to B, you have a case of deposit. Remember, you have deposit, and here you have case of borrowing. So basically, A, B, C line, this line tells you the consumption pattern or opportunity, your investors opportunity set. If he takes or he considered any of these choices of consuming 10,000 that he is going to get for 2 consecutive time periods. So this is the first question. If you remember, we said that we are going to analyze consumption and opportunity set. Opportunity set means what kind of possibility exists when we consider all 3 different scenarios. So those like, one's point B, point A, and point C are basically your opportunity set. How much would be you will be enjoying if you go for some kind, separate type of different type of investment policy. Now coming to second point. Second point is specify how to choose among those options, because every individual is different. So, and that's why it is going to be decided by this kind of curve. We call it indifference curve. And this is representing indifference curve for a particular investor. It means all the point in this curve will give same kind of, utility, or same kind of, investor will be indifferent at every point. Means he will have same kind of utility all the point that exist in this curve. So this is for your investor zero investor 1, 2, 3. So you have different type of investor. So this is what we call it indifference curve. So if we want to know what is the optimum level, to know the optimum level, this line, your indifference curve, should be tangent, because then only you will get one optimum point that satisfies the utility or utility of your investor I2. So in all these 3 given choices, point D represents the best optimum investment choice for investor. And if indifference curve, basically what happens, you can, it moves. Why moves? Because based on the level of consumption, it will have movement. So this can represent this, we can assume that either this represent indifference curve for different investor, or indifference curve for a single investor, but at certain point of time. So it is up to us. So what this suggests, that for optimum benefit, what investor should do? Investor should consume 8,000 for initial period. Let's say here initially he got 10,000 first time period, and second time period he is also getting 10,000. So what this person should do? He should basically consume 8,000 out of 10,000. It means he is left with 2,000. So he can deposit 2,000 for a year. It means at the end of this year, he will get 10,000 plus 2,000 into 1.05. So if you calculate, it comes 12,100 rupee. So if you add these two, so it comes 20,100. So what it suggests that for this investor, I2D point is the optimum, because at this point he will be indifferent for all these points. He will be indifferent between selecting any two investment option. So this point is going to be the optimum investment for investor, and he should select this kind of consumption pattern to maximize his utility or her utility. And there could be argument that why someone cannot select any point here. Someone cannot select any point here because your opportunity set exists only line A, B, and C. Of course, here if you say that here you have high what you call high value of your investment or your total consumption, but because this does not intersect or does not lie on your opportunity set, that's why we cannot consider this or this. We can only consider these two, but here you are getting two intersection points, so it is difficult to get a unique solution. So basically this point D, which is intersection of your opportunity set and indifference curve, will give you the optimum investment. So your second point, this how to choose among the option, it will depend upon opportunity set and investors indifference point or investors utility. It means, of course, you may have n number of choices and you offer to your client, but it is the client's decision what choice he or she is going to select, because his or her indifference point or risk aversion level is going to decide. And that's why unless we discuss about utility theory and utility curve, we cannot understand well portfolio theory. So whether this part is clear, everyone? If you have any question, we can take.
So I understood all the math behind it. I just did not understand what is the utility of conducting this analysis?
Yes, the utility is many times, when we do analysis, we assume that if XYZ combination of portfolio is giving high return, we say that this is what your client should go for, right? Like when we do analysis, we use lots of math, we get one optimized portfolio. We say I can ask my client to invest in this way, but we never think of indifference curve or how investor wants to put. Investor will only put money or investor will only take decision when he is happy with his investment. He is happy with the various criteria that he has set. He may be risk neutral or he may be risk taker. So probably whatever you are suggesting, he may not accept that. So the overall reason why I have discussed this, to know how investor is going to select a particular investment choice, considering two-period model here, two-period consumption model. And why consumption model I have selected? Because when investor is not consuming all but saving for investment, that investment leads to portfolio theory or building portfolio theory, because unless you have access money to invest, you cannot buy security. And if you are not buying security, then there is no point to discuss, portfolio theory and optimum portfolio, creation. So that's why I know this is very important theory related to consumption and investors, equilibrium. Because in CAPM, when we are going to talk about Markowitz theory, EV theory, we call it EV theory, which is the basis for your portfolio theory. So if you today we could not start. So you read this Markowitz 1956, I believe, portfolio theory, portfolio investment paper, portfolio, I think theory title is portfolio theory, portfolio selection theory, sorry. He has written thesis on portfolio theory, and you won't believe initially he was not able to publish that theory, but ultimately his thesis work became the start point of portfolio theory. So in this way he has contributed. So later on, even I think after 10 or 12 years, he could publish his PhD related work, this portfolio related work. But now we all are giving credit to Markowitz that he is the father of portfolio selection theory or portfolio theory. So next week we are going to talk about on there these indifference curve and opportunity set. We are going to deal in our discussion. So I think, yeah, this is what I have planned to discuss in this module. So next week onwards, we will start our discussion on